This is Matthew Cratter from Trade University, and today I want to answer the question, will the economy end in fire or will it end in ice? As I've been arguing for the past couple months, the Fed, the Federal Reserve, which is the central bank in the US, has been committing a policy error. They are raising rates much too quickly and much too much, given where U.S. debt to GDP levels still are. They're still much too high for something like this. This is basically economic madness, what they're doing. We've also argued that perhaps there's a strong geopolitical reason behind it. Maybe the Fed is tightening at the behest of the U.S. State Department or the Department of Defense to try to tank energy prices, global energy prices, and thus defund Putin's war machine. Quite possibly there's a strong geopolitical reason like this behind Fed policy. Maybe something like this: you raise interest rates very high, allow the US dollar to get really strong and blow up currencies and economies around the world. This seems like a pretty evil thing to do, but this may be an act of reasserting global hegemony through the US dollar. So discounting all of these things, what I want to focus on, apart from these sort of geopolitical concerns, is why we know that they're committing a policy error from indicators, and why I think that they're going to take the way of inflation eventually. So we know that they're committing a policy error because of the heavily inverted yield curve, and also because we can see the financial markets imploding. This is not normal behavior. Here's the basic problem: debt to GDP is much too high. We can see that in the 70s and the 80s and the 90s, it was more between, call it 40% and 80%. And then for the past decade, for the 2010s, it was moving around 100%. And then in the wake of post-pandemic and pandemic spending, we've reached this point that for many countries is a point of no return when you get above 120% debt to GDP. We were saying that we know that the Fed is too tight because of how inverted the yield curve is. We can see here that the 10-year yield versus the 2-year yield is still highly inverted at minus 42, 43 basis points. So this is why we know the Fed is too tight. They are too tight given where debt levels are in the economy. The US economy has too much leverage in it to be able to handle interest rates at this level, or to be able to handle the Fed attempting to shrink its balance sheet, which basically means selling assets into markets that are already falling. I've said this many times on the channel that the only real way out of this mess is to inflate our way out. And I often get this objection, which I want to talk about today. Here is CMAC 13 talking about my idea of inflating our way out of this economy, this economic mess. He says, "This is hilarious. Inflating is literally the worst thing that you can do. I'm very surprised you think that, but you've been wrong the whole time. Guess you're not considering the long-term impacts of printing and high inflation forever. They haven't even started shrinking the balance sheet yet." So this is a good question. This is where the title of this video comes from. It comes from a Robert Frost poem. He was a prominent 20th century poet who I believe he read a poem at JFK's inauguration ceremony, but a very good poet. And this is a very short one, so I'm going to read it. "Some say the world will end in fire, some say ice. From what I've tasted of desire, I hold with those who favor fire. But if it had to perish twice, I think I know enough of hate to say that for destruction, ice is also great and would suffice." So this is the metaphor I'm using. And we have no pain-free solutions now. So when I suggest inflation, you have to understand it's in this context of only having bad choices left because of decisions made by past generations. There are no pain-free solutions left for the US economy or the global economy. So as Robert Frost would say, some say this mess will end in fire, which would be high inflation. Some say ice, which would be deflation and possibly a deflationary debt spiral. Now I get it, double-digit inflation, as we've experienced over the last couple of years, is quite painful. It's painful at the gas station, at the pump, at the grocery store, and everywhere else. But what I'm going to argue in this video, and as I've argued before, the alternatives to it, the alternatives to inflating your way out of this mess never, ever work. So let's take a look at the way of ice, which would be the opposite of inflation. One way of approaching this would be you could massively cut government spending and raise taxes in order to balance the federal budget. This would at least slow the growth of government debt because the government would be living within its means and not having to issue so much debt. But if we take a look at the large line items, we have government spending of about $6 trillion. We have the really large budget items are Medicare, Medicaid, Social Security, defense, and interest on the debt. These are the largest items which we're going to talk about now. Now, if you're a politician who cuts Social Security or Medicare, you will get immediately voted out by your constituents, and you'll get replaced by someone who will restore these benefits. This is what always happens. It's also a pretty crappy thing to promise people money in their retirement and then yank the rug when they are already old. Now, it's also pretty much impossible to cut defense spending during an escalating conflict with Russia and China. So what I'm doing here is I'm arguing you can't cut Medicare, Medicaid, you can't cut Social Security. At this point, the time to have made these cuts were in the 80s or 90s or early 2000s. Defense spending, war spending, you can't really cut that during a great power competition with Russia and China. You also can't skip paying interest on the debt, which is this line item here. This is set to go up massively as the old debt rolls into new debt at much higher interest rates, and this is going to be above $1 trillion before we know it. You can't skip paying this interest, though, in the debt, because that would be a default by the issuer of the global reserve currency, which is the US. Then the government would have no way to fund itself. It would also, a default by the US would trigger a global depression. What happens in a recession or global depression? Economies shrink. They become even less able to service their massive debt loads. And so the debt to GDP levels basically increase as GDP goes down and the debt stays the same. And so this defeats the whole purpose of trying to bring debt to GDP back down. If you're finding this video helpful so far, I just ask you to hit that subscribe button. Also hit the like button and share this video with a few friends. So what are some other ways to get debt to GDP levels lower in the context of our way of the ICE? Well, you could pay off a lot of the debt, but the problem is where you can get the money to do this. You could print up the money, but that's inflationary. That's not deflationary. You could, let's say you just raise taxes a lot, and we'll do the extreme situation. We'll basically raise the marginal tax rate on billionaires to 100%. We'll soak the rich, and we will confiscate everything that they own. Now, of course, this is not exactly the best way to honor private property or to encourage future entrepreneurs who are definitely going to be less motivated if they know that their future fortunes could be confiscated. But there's a practical problem as well. If you take US billionaire wealth, this was, I believe, this number was taken before the market crash this year, and so billionaires' wealth has gone down a huge amount. But let's just use this number. 2.62 trillion is the net worth of all the billionaires in the US. So 2.62 trillion, but US government debt is actually closer to 31 trillion now. If we look here, it's at 31 trillion, and this government data is just delayed. So you could basically, let's just say it's 3 trillion of billionaire wealth and then 30 trillion in total public debt. You could just confiscate all their houses, all their yachts, etc., sell everything off, and you would have only paid off 10% of the debt. And basically this debt is going up by about $1 trillion a year, even before the recession hit and the stock market collapse hit. So you cannot confiscate wealth. It's the wrong thing to do. I'm not a fan of a lot of our billionaires. I am a fan of some of them, but you cannot do this, and it doesn't even make any sense. And the socialists who suggest this have no idea what they're talking about, and they probably majored in something that had nothing to do with economics to begin with. So that's one of the ways of ICE. What if you, in addition to raising taxes, what if you cut government spending? The problem now is that government spending is such a large chunk of the economy. It's somewhere around, call it 35, 36% of GDP. And when government spending is such a high percentage of GDP, if you cut it massively, you are basically cutting one of the major sources of GDP. This will cause GDP to fall. This will lower the denominator in the debt to GDP ratio, and this makes debt to GDP go up rather than go down. So we're trying all these different ICE solutions. Here's the basic problem: austerity, defaulting on debt. These are not options. You also can't just forgive all the debt, because one person's debt is another person's asset. And so, for example, these US Treasuries are in almost everyone's retirement accounts. And so if you just cancel the debt or forgive the debt, that's good for the US government, but all of a sudden people's net worths implode. And I'll link to this video below if you want to learn more about debt jubilees and the modern problems with those. So these are the reasons that I believe that the US will ultimately choose the route of high inflation, which it had been pursuing from 2020 to the beginning of 2022. Perhaps this will have to wait until Putin is defeated. Hopefully he can be defeated and we don't end up with a small nuclear war event in the process. I'm quite worried about, I'm not a huge fan of Putin, but I also think you got to be careful backing him into a corner when he's an old man and might just be prepared to take himself out with a lot of other people. This is a really delicate matter, and so the US might have to hold off on this inflationary path for a bit longer, assuming that the debt markets hang in there and don't completely implode or freeze up. People don't realize that high inflation has been used before to bring down US debt to GDP levels in the wake of World War II. This is something called financial repression. I'll link to this in the description notes below. This is from the Wikipedia article on financial repression. Financial repression, which is basically keeping interest rates, pinning US Treasury rates below the rate of inflation. This played an important role in reducing debt to GDP levels after World War II by keeping real interest rates for government debt below 1% for 2/3 of the time between 1945 and 1980. The United States was able to inflate away the large debt left over from the Great Depression and World War II. Debt to GDP was very high at that point at 122% as well. So we're in a very comparable situation. I'll also link to this article from the Federal Reserve about financial repression and how it's a tool of government finance, how in 1942 the Fed agreed with the US Treasury to peg interest rates below the rate of inflation, and they kept this thing going until 1951, thus bringing down debt to GDP levels. Inflating your way out of this mess, what does this mean? Well, it means you need to grow that denominator. You need to grow nominal GDP in the debt to GDP fraction. Nominal GDP growth is equal to inflation growth plus real GDP growth. This is roughly the way of calculating it. You increase real GDP growth through technological progress and through entrepreneurial endeavors. So for example, nuclear fusion would really help US real GDP, but this is not something that we can count on in the short term to get our way out of the problems. But any sort of technological innovation that allows you to do more with less helps to increase real GDP. What's the best way to slow down an increase in real GDP and slow down technological progress? Well, it's exactly what the US has been doing for many years now. Lower academic standards, fill up colleges and universities with people who don't belong there, and then fire their professors when they say that their chemistry class is too difficult. The other way to really slow down scientific and technological progress is to have a bunch of bureaucrats be in charge of the funding. And most US science at the colleges and universities and other research facilities is driven by US government spending. This article bemoans the loss of that spending, but I think this is actually a good thing because government bureaucrats are not exactly good allocators of capital, and many of these people know nothing about science to begin with. So these are long-term solutions for growing real GDP. You need technological progress. You need to promote and help the really smart people and not pretend that some people can handle it. It's almost impossible to grow real GDP by a lot in a short period of time, as we've been saying. So unfortunately, the US is going to need to resort to inflation to grow nominal GDP. Again, nominal GDP is just inflation plus real GDP. And if you can't grow real GDP, you're going to have to grow inflation. And this is how it will work roughly. Let's say you used to make $45,000 a year before we had a period of high inflation, and now you make $90,000 after a multi-year period of both wage inflation and CPI, goods and services inflation. You basically doubled your earnings. Your wages have gone up a lot, but everything costs a lot more now. So your standard of living has probably not improved, and it may have even fallen. But here's the important thing, at least from the government's perspective, you're paying much more in taxes because you're paying taxes on a much higher salary base, and they don't adjust the tax brackets really for inflation. And so you're now in a higher tax bracket, even though you're not wealthier, and you're paying more taxes, which can be used to service the debt. This is the only way out of really high debt to GDP levels. Fire is the answer. Inflation is the answer. You can try ICE for 12 to 18 months, as we seem to be doing now, but you're going to have to return to inflation as the solution before too long. This is what we saw happen in the UK, where they turned the money printers back on about 10 days ago, and they decided that the way of ICE was not going to work for them, and instead they were going to have to bail out the whole pension system with the money printers, which is the way of fire. So I think the U.S. economy ends in fire. We probably don't get true hyperinflation, at least in this decade, but I do think that the U.S. is going to have to resort to a period of, call it 5 years, of very high double-digit inflation, call it 10 to 20% a year. This will bring debt to GDP levels back down to a more normal level where you can have more normal Fed policy and you can raise interest rates without blowing up the whole economy, the whole U.S. economy and the whole global economy, as the Fed has chosen to do now. If you found this video helpful, be sure to hit that subscribe and like buttons. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.